I wouldn't be overly concerned, but there is what I call asymmetric risk to the upside. We have supply disruption. If we have extended conflict or widening war unfortunately is very energy intensive. So we have that demand side of the equation. We also have the U.S. maybe not turning such a blind eye to sanctions violations as assets move into that area and dark ships are picked up. We've been tracking a lot of ship-to-ship transfers, that ships that turn off their AIS transponders through SynMax Energy, and maybe that gets halted. And so with insurance rates maybe going up, threats to supply, disruptions going up, the market has to adjust the price and the probability of certain things going on. So there's this concern about a recession, and I'm not a big believer in a big drop in demand, even in a normal monetary tightening recession. That was had the risk off and people actually kind of selling oil contracts. But now with the wider conflict and those other risks, the market has recalculated what the fair price is.
But are you surprised, Bill, that there's been some sort of complacency in the market, even the way the oil market scaled back after the initial shock?
Yeah, it's been pretty strange to see, stocks depleted, not as much investment into oil and gas that's going on, and this kind of complacent rally that we've had. And then we have this kind of readjustment to prices overnight with the conflict. But I think people are in a wait and see mode. I don't know what's to come into this war, but usually these things tend to last longer and get worse before they get better. And so I would say that the risk is to the upside. But I mean, if we're looking at oil as a war risk product, I think there are better products other than just the direct commodity. There's defense sector that's going to have a lot of capital flowing into it. But irrespective of war, crude is bullish.